Hi, thanks for watching me work problem E817 from page 470 in your textbook. This is a direct write-off. And in this problem, E817, it does ask you to skip cost of goods sold, but we're not going to do that. We're going to use a cost of goods sold of $10,000 because I don't want us to get in bad habits when we do sales transactions. So let's just go ahead and do it like a regular sales transaction and include cost of goods sold. So let's just get right into this. We've got our journal set up and we're going to see what happens here. So on June 1, 2018, Best Performance Cell Phones sold 21,000 of merchandise to Anthony's Trucking Company on account. Alright, so that's just a sale. That's really nothing new for us. So for a sale, we're going to record that. This is 6/1/18, and we have it now an account receivable, and we'll label it from Anthony's Trucking Company so we can keep it straight from other people's transactions. 21,000 is what we sold, and of course when you make a sale you get sales revenue. So 21,000 in sales revenue. Here's where that cost of goods sold comes in, right? When you make a sale, you always have the receivable or cash plus your sales revenue. Then you have your cost of goods sold, and I told you it was going to be 10,000. And of course, we reduce our merchandise inventory, right? They left here with the phones, so we no longer have those phones. So there's that first transaction. Just a regular sales transaction. Now, we find out Anthony fell on hard times and on July 15th paid only $5,000 of the account receivable. Alright, well, so you pay for stuff with cash, so that means cash came in of $5,000. And of course it went towards the account receivable. Anthony's Trucking Company. So we got $5,000 in cash, and we reduced the asset, account receivable, by the $5,000. So really that's still just a normal transaction. Yes, it's less than what they owe, but still we just collect cash, post it towards the account receivable. At this point maybe we don't realize we're not going to get the whole thing. Alright, so the next thing in the problem, after repeated attempts to collect, Best Performance finally wrote off its accounts receivable from Anthony on September 5. So there's the write-off. We decide, okay, I guess this guy's not going to pay us, so we got to write it off. But how much? Well, he owed us $21,000, but he paid us $5,000, so he really only owes us $16,000 at this time, and that's the amount we're writing off. And of course we write it off to bad debt expense. So 9/15/18, bad debt expense. And who are we writing off? This account receivable, Anthony Trucking Company, and it's $16,000. All right, so that's it. We've given up, and we go on about our business. And then what happens? Well, the next year, on March 5th, 2019, we received Anthony's check for $16,000 with a note apologizing for the late payment. So that's pretty cool. We get the money back. But look, we have no place to post it. We've written that off to bad debt expense. So we have to reverse this transaction so we have a place to post that check that we got. So the first thing we do on 3/5/19 is just reverse that. So account receivable, Anthony's Trucking Company, 16,000, and then bad debt expense, 16,000. It's back on the books. Now we can post the payment. So really that's just like this, right? It's just a payment. We're posting it. It's for $16,000. So we got on 3/15/19, we've got our cash that came in, 16,000. We're getting rid of that account receivable from Anthony's Trucking Company, 16,000. All right, so that's how you do those journal entries. That's about it. You're right. You can have a sale. You can accept payment for that account receivable. Maybe you write it off. Maybe you reinstatement. Maybe you get it back in the end. The only issue with this, which the problem does ask about, it says, what are some limitations when you're using direct write-off method? So direct write-off method is problematic because, as you can see, we wrote this off back here and had this big bad debt expense in 2018. So our 2018 income statement showed an expense that we really wound up not having, and then an asset that we actually did have was not on the books, and then in 2019 is already after the financial statement. So this is kind of a mess for accurate financial statements, which is why most companies don't use it. They will use what we call the indirect write-off method using an allowance. So we'll look at that in the next problems. All right, thanks for watching. I'm glad you learned something today. See you in the next video.